Well, there's a lot of noise and inflation everywhere these days, but in Brazil we had the first months of the year, which we had the higher inflation for food products. Actually, that raised some concerns in the government, but we think that was more of a seasonal effect. So we are seeing now a period where inflation will go lower. The print that we had, the last print that we had was actually a little bit lower than expected, and we think we're going to have lower prints from now on. But it depends on still a lot of things that we are watching, and I think one of the things that still has not converged is inflation for services, which is still running high. And because the labor market is somewhat tight, we are trying to see how can we access what's happening on inflation for services. On goods, we're seeing inflation decreasing. On food prices, it went higher and now it's decreasing. Overall, I think the inflation convergence is in line with what we expect.
A lot of central banks are looking at a last mile approach to inflation. Are you a little bit further off the last mile as you target 3%?
Yeah, well, it depends because the number is higher. So I guess the last mile, the last miles, at the end, the process is similar in many places. What we are seeing in many places is this disinflation process that is accompanied by full employment. And it's something that doesn't come around very often. So everybody's trying to access and to understand, how is the last mile of inflation going to be with the labor market so tight? We still have a lot of fiscal stimulus out there. We still have excess savings from what was done during the pandemic. So overall, I think a lot of the places are actually looking at the same variables. In the case of Brazil, I would say that we had a better print, the last number. And given the tradition and the history of high inflation in Brazil, I think we have done reasonable conversions with very little cost to society. So the growth has been revised up. Like I said, labor market is doing well, credit is going back into growth, but inflation is converging to the target.
If we talk about rates, the Celtic rate is at 11.25%. It was reduced again down by another 0.5% in February. How restrictive is that level currently, and how are you thinking about rates for the rest of this year?
Well, it's a very good question, and actually people look a lot at nominal rates and real rates, but the fact that we need to take into consideration is that the neutral rates in Brazil are higher. And for monetary policy, what matters is not the real rate that you have, it's the difference between your neutral rate and the real rate that you have at the time. And when you look at that, our difference is actually smaller than most other places in Latin America. Why? Because our neutral rate is much higher than most other countries. So when we think about what happens in rates in the longer term, what we need to do and design is policies to bring down the structural rate, the neutral rate.
Policy divergence looms now thanks to the US battling hotter than expected numbers recently on retail, CPI and jobs. What consequences does that have for your monetary policy?
I think it has a lot of consequences, and I think it's a story that goes in cycles. So I think it was almost a given that the last mile was going to be achieved. Now I think people have more doubts on where the disinflation is going to come from. And then the question is, if we are moving from a process in which we saw the last mile to a process of more uncertainty, and this uncertainty means perhaps higher rates for longer, then I think we'll probably shift to a new issue, which is people will talk more and more about the fiscal and the sustainability, because we have a huge debt coming out of the COVID. And if we have higher rates for longer, then the sustainability of the debt, not only in the US, but in many other places, and the fiscal, I think, will come into place as being something that economists will talk about a lot in the next couple of months.
There's already a huge casualty list when it comes to emerging market currencies that have battled depreciation against the US dollar. Some engagement today between the Japanese and the Americans around FX. Do you think that there are disorderly moves unfolding in markets?
I think what we have now is a repricing of what the terminal rate in the US is going to be. And because of that, as a consequence of that, you're seeing a repricing of FX in general. I think Brazil is different this time around because we have an external part. When you look at the trade balance and what we've seen in terms of flows that is much stronger than the past. So I think Brazil is better prepared this time around to deal with that than it was in the past. But that doesn't mean that you're not going to have some kind of repricing. So we are watching what's happening. And for us, what's important is the implications of this process to our framework of monetary policy.
How concerned are you about the fiscal side? Because the primary fiscal surplus in Brazil is expected to be 0.5% next year. Critics say there's no commitment to control government expenses in the country and that you'll be facing higher interest rates for a while. Is Brazil in danger of a financial crisis or some sort of fiscal crisis?
Well, the fiscal is more an issue of the Minister of Economics than the central bank. For us, what's important from the fiscal is the variables that are affected by that. And what we always say is that we need to have harmony between the fiscal policy and the monetary policy. And the problem when the credibility in the fiscal policy is affected is the price of the monetary policy becomes higher. So when you have credibility issues on one side, either side, you affect the other side. So the question right now is Brazil has been a fiscal story for a long time, and this government has tried very hard to address this issue. So the question for us right now is we just had a revision of some of the targets, but the question is how that impacts the variables that are part of our framework.
We are seeing huge geopolitical forces at play, which is impacting the way countries think about their supply chains. China plus one strategy unfolding. How is that impacting Brazil? Are you seeing more investment, more capital flows than you would normally?
I think this story has two sides. One side of the story is that it is an inflationary pressure globally, because when you're talking about reshoring and friendshoring and reconsidering your supply chain, most of what's being done is at a higher cost than we had before. On the top of that, you have the greening and the sustainability effect, which has a very good effect in the long term, but in the short term means also more inflation. And on the other side, it presents an opportunity because Brazil is a country that has a huge capacity to produce clean energy. We have a huge labor market, a very big internal market. So we are a country that is a very good candidate to produce inputs for the other country in a much more sustainable way.
Just finally, how is Brazil thinking about the potential for a change in administration in the United States later this year, another Trump administration? Would there be consequences for Brazil economically?
I try to look at what the markets are saying, and I don't think there's going to be a lot of volatility in the markets around that. It's perhaps not very wise for a central bank to comment on what's going to happen in politics in other countries, but I try to see what could be the impact for us in terms of monetary policy, and I don't think we're going to see disruptions in market because of that.